$6,300. That is JPMorgan's official, published, on-the-record price target for gold by the end of this year, Q4 2026. Not some fringe blogger, not some gold dealer trying to sell you coins, the largest bank in the United States of America, the institution with $3.9 trillion in assets on its books. They looked at the market, ran their models, and said, gold is going to $6,300 an ounce by December. Now here's the thing that should stop you cold. Right now, as you're watching this video, gold is sitting around $5,100 an ounce. The Fed just told markets, with a straight face, that they're holding rates steady at 3.5 to 3.75%, and they're in no hurry to cut. The CME FedWatch tool, which tracks what traders are actually betting with real money, shows a 95.6% probability the Fed does absolutely nothing at the March 18th meeting. 95.6%. The Fed is putting the brakes on while JPMorgan is flooring the accelerator. And I need you to understand something. In this tug of war between the biggest bank in America and the Central Bank of America, there is a very specific reason why the bank is going to win. And by the end of this video, you will see exactly why and what it means for you. Let me give you the full picture first, because context is everything here. Just 12 months ago, gold was trading around $2,624 an ounce. That is not ancient history. That was March 2025. Today, it is roughly $5,100. That is a 94% move in 12 months. For perspective, if you had put $50,000 into gold this time last year, you would be looking at roughly $97,000 today. The S&P 500 in the same period? Nowhere close. But here is what makes this genuinely remarkable and what nobody is putting together properly. JPMorgan didn't just quietly raise their year-end target to $6,300. They did something more telling. On February 25th, 2026, less than 2 weeks ago, they simultaneously raised their long-term gold price forecast by 15%, lifting their long-term target to $4,500 per ounce. Now, if you don't follow analyst forecasting, that might sound confusing. Why would they raise a long-term target that's lower than their 2026 target? What that actually signals is this. JPMorgan is saying the entire price floor of gold has permanently shifted upward. They're not just calling a spike, they're calling a structural repricing of what gold is worth as an asset class. That is an enormous difference. Now let me show you the raw data behind that call, because this isn't speculation. This is documented institutional positioning. According to the World Gold Council, central banks accumulated 863 tons of gold in 2025. That followed over 1,000 tons each in 2022, 2023, and 2024. JPMorgan's own research forecasts 755 tons of central bank purchasing in 2026 alone. And here's the key mechanic that their analysts explain. At these elevated prices, central banks don't need to buy as many tons to move their gold allocation to where they want it as a percentage of reserves. The buying is slowing not because they want less gold, but because they need fewer ounces at $5,000 than they did at $1,800 to achieve the same portfolio objective. Meanwhile, as of February 24th, 2026, COMEX net long positions, meaning professional institutional traders making large directional bets with real money, exceeded 300 tons, according to Bloomberg, the CFTC, and the World Gold Council. That is significant. That tells you this rally is not retail-driven. This is not people panic buying gold coins on the internet. These are hedge funds, institutional managers, and professional allocators systematically adding gold exposure with conviction. And gold ETFs? They added $5.3 billion to assets in February alone. That's 26 tons of demand flowing into exchange-traded products in a single month. Quick note before we go further. If this kind of unfiltered, data-driven analysis is cutting through the noise for you, hit subscribe. My analytics show about 3 out of 4 people watching right now aren't subscribed yet. It helps the algorithm get this in front of more people who need to see it, and it tells me who the serious community is. Now back to the evidence, because it gets a lot more interesting from here. Let me now explain the tension, the actual contradiction sitting at the heart of this market, and once you see it, you will not be able to unsee it. The Federal Reserve, as of January 28, 2026, held the federal funds rate at 3.5 to 3.75%. That is the official data. After 3 consecutive cuts at the end of 2025, the Fed slammed on the brakes and said, "We're waiting." Chairman Jerome Powell noted that while tariff-driven inflation is fading in the rear view, they still have PCE, the Fed's preferred inflation gauge, sitting at 2.8%, above their 2% target. Their own summary of economic projections signals only one 25 basis point cut for all of 2026. Here's the conventional wisdom. High rates are bad for gold. Gold pays no dividend, no yield, no coupon. When interest rates are high, you can park your money in a treasury bond and earn a real return. So why would you hold gold? That's the argument the Fed is banking on, literally. But here's where the story fractures. Gold has risen over 7% in 2026 alone, even with the Fed holding rates steady. It hit an all-time high of $5,595.42 on January 29th. Even after pulling back, it has stayed above $5,000 for most of February and March. It is defying gravity in a high-rate environment, and that defiance is not random. It is telling you something profound about what has changed in the structure of global finance. To understand this properly, I need to take you back through a specific historical pattern, because this isn't the first time we've seen a major bank issue a blockbuster gold target while the central bank was tightening. This exact dynamic has played out before. Cast your mind back to the 1970s. The Federal Reserve under Arthur Burns was trying to control inflation. Rates were rising. The conventional wisdom said gold should struggle. Instead, gold went from $35 an ounce in 1971 to $850 by January 1980. That's a 2,300% move. Why? Because the underlying issue wasn't just interest rates. It was a fundamental loss of confidence in the US dollar as a reserve asset after Nixon closed the gold window in 1971. When the dollar's relationship with real assets broke down, no level of rate hiking could stop gold from repricing to reflect that reality. Fast forward to 2008. The Fed cut rates to near zero and launched QE. Gold responded immediately, rising from around $750 in October 2008 to over $1,900 by September 2011. Not just responding to low rates, responding to the implied message that the Fed would print its way out of a crisis, debasing the currency in the process. And now we are in the third iteration of this pattern. Only this time, there's something new in the equation. And this is the part that JPMorgan's analysts are placing enormous weight on. Central banks, not just investors, not just hedge funds, but the sovereign institutions that literally create and manage the world's reserve currencies, have been systematically buying gold for 17 consecutive years since the global financial crisis. The National Bank of Poland bought 83 tons in 2025. Kazakhstan added 57 tons. Brazil's central bank re-entered the gold market after a 4-year absence, adding 43 tons between September and November alone. Poland's governor publicly stated he intends to push their reserves to 700 tons and cited national security reasons. Kazakhstan's governor said they want to remain a net gold buyer until global tensions ease. These are not investment decisions. These are geopolitical decisions. These countries are structurally reducing their exposure to dollar-denominated assets. They are not doing this because they read a bearish Fed note. They are doing this because the dollar's role as the world's reserve currency is under genuine, structural pressure for the first time in decades. JPMorgan's analysts specifically cited what they call a reserve currency paradigm shift as the core driver behind their $6,300 call. When a bank with $3.9 trillion in assets uses the phrase paradigm shift, they are not throwing out clickbait. They are telling their institutional clients, the sovereign wealth funds, the pension funds, the asset managers who pay them for research, that this is a structural change in how the world stores value. Now let me show you the numbers JPMorgan is using to build their $6,300 model, because this is where it gets genuinely fascinating. Their research team, specifically using a model that explains roughly 70% of the quarter-over-quarter change in gold prices, is built around one key variable: tons of combined investor and central bank demand per quarter. Their framework says you need at least 350 tons per quarter for gold prices to rise. Every 100 tons above that threshold is worth roughly a 2% quarterly price increase. For 2026, JPMorgan is projecting 585 tons per quarter of combined demand. That is 235 tons above their minimum threshold. Running through their model, that supports continued price appreciation from current levels. When they compound that across 4 quarters toward year-end, you get to the $6,300 figure. This is not a back-of-the-envelope guess. This is a quantitative model backed by structured data. And the demand breakdown? It's 190 tons per quarter from central banks, 330 tons from bar and coin investors, the people and institutions buying physical gold, not paper, and another 275 tons annually from ETF and futures demand, which they expect to be front-loaded early in 2026. But here's where it gets interesting. Stick with me because this next part is critical. JPMorgan is not alone in this call, not even close. But the divergence in how bullish different institutions are is itself a signal worth examining. Goldman Sachs projects gold reaching $4,900 by year-end. Morgan Stanley is at $4,400. Bank of America has a 2026 scenario pointing toward $5,000. UBS says gold will reach $5,000 in the coming months. RBC Capital Markets forecasts gold averaging $4,600 for the year. Macquarie Group just raised its Q1 2026 estimate to $4,590. Now look at that landscape carefully. The most conservative major bank forecast for this year is still 10% above where gold sits today. In JPMorgan's bull case, the highest price target from any major institution sits at $6,300. That is a 23% upside from current levels by year-end. In what other mainstream asset class are you looking at a credible year-end range of $4,400 to $6,300 with every single major bank bullish? The answer is, there isn't one. Now here's where I want to talk about something that most videos on this topic skip entirely, and it's arguably the most important structural piece of this puzzle. There's a Department of Justice investigation currently underway into Federal Reserve Chair Jerome Powell. His term expires in May 2026. Treasury Secretary Scott Bessent has already published a shortlist of replacements. That shortlist includes BlackRock executive Rick Ryder, who is reportedly the frontrunner. The analysis published around that appointment suggests, and I'm quoting the substance here, not my words, that a Ryder-led Fed would likely be viewed as more pragmatic and forward-looking, with a lower assumed neutral rate. What does that mean in plain language? It means the market believes the next Fed chair is going to cut rates faster and hold them lower than Jerome Powell would. The moment that becomes official, the opportunity cost of holding gold collapses. When you can barely earn a real return holding treasuries, and you can hold gold that just went up 94% in 12 months, the calculus changes dramatically for every institutional portfolio manager on the planet. The gold market is not waiting for that transition to happen. It is pricing it in today, which is exactly why gold is sitting above $5,000 even while the current Fed holds rates at 3.75%. Let me now show you what this looks like on the ground, in the physical market, because the paper futures price and the real-world demand picture are telling the same story from two different angles. COMEX warehouse stockpiles, according to data reported by Brave New Coin, have been dropping to alarming lows. The warehouses that physically back the futures contracts being traded on paper in New York are seeing actual drawdowns. Now, you might ask, why does that matter? Because if you sell a futures contract promising to deliver gold, you need to actually have the gold somewhere. When warehouse inventories shrink, at the same time paper trading volume is elevated, it creates a structural tension in the market. Either physical supply catches up, or paper prices eventually reflect what physical supply is actually worth. And on the physical demand side, look at China. The Shanghai onshore gold premium, which measures how much Chinese buyers pay above international spot prices, swung from a 1% discount last September to a 1% premium in February 2026, the highest since April 2025. When Chinese buyers are willing to pay above global market prices to get their hands on physical gold, it tells you something about the depth of that demand. This isn't speculative. This is people choosing to pay more because they want the metal in their possession. Chinese investment and retail demand remains, in the words of State Street Investment Management, steady and sticky, even against record domestic gold prices. Let that sink in. Even with gold at all-time highs in Chinese yuan terms, Chinese retail investors are still buying. Now let me bring in the Fed piece more precisely, because the Fed crushes prices dynamic in our title is real and documented, and understanding it is what tells you where the opportunity is. The Fed's December 2025 Summary of Economic Projections penciled in just one 25 basis point cut for all of 2026. Markets pushed back immediately. With unemployment ending 2025 at 4.4% and limited job creation, what Business Insider reporters are calling a low-fire, low-hire environment, many analysts believe the Fed will be forced to cut 3 or 4 times in 2026, regardless of what their projections say. When unemployment keeps rising and the labor market stagnates, the Fed's hand eventually gets forced. 2 Fed governors already voted to cut rates at the January 28th meeting. Christopher Waller and Stephen Moran both dissented and pushed for an immediate 25 basis point reduction. The Fed is not unified. The hawks are holding the line against an increasingly vocal dovish faction. And that internal fight is going to be resolved by economic data that comes in over the next 3 to 6 months. Here's the critical insight. Gold has historically rallied before the Fed cuts, not after. According to data cited by USA Gold, gold rallied from roughly $3,000 to over $4,300 in 2025 as the market anticipated the September rate pivot. The institutional money moves early. By the time the rate cut is official and in the headlines, the gold positioning is already established. That's what sophisticated institutions do. They don't buy when it's obvious. They buy when it's predictable. Let me walk you through the math of what happens under different Fed scenarios. This is not financial advice. I'll repeat that clearly. But the scenario modeling is instructive. Scenario 1. The Fed cuts once in 2026, as projected. Gold stays in the range of roughly $4,000 to $5,000, consolidating. Still profitable from current levels for anyone already positioned. Scenario 2. The market's view is correct and unemployment forces 2 to 3 rate cuts. According to multiple major bank forecasts, this pushes gold toward the $5,500 to $6,000 range. JPMorgan's $6,300 target becomes plausible. Scenario 3. Something breaks. Geopolitical escalation, a sovereign debt shock in Europe or Japan, a credit event in U.S. commercial real estate. The World Gold Council's bull case scenario, published December 4th, 2025, projects gold rising 15 to 30% from current levels under a serious economic downturn scenario. From $5,100 today, that 30% scenario gets you to $6,630. JPMorgan's $6,300 target starts to look conservative. Now here's the thing I want you to hold on to. The most bearish, credible scenario, the Fed is right, economy stays strong, rates stay higher for longer scenario, has gold correcting 5 to 20% from current levels. That would put a worst-case floor somewhere in the $4,000 to $4,800 range. That's still 60% to 83% above where gold was trading just 12 months ago. The asymmetry here is remarkable. Upside to $6,300 plus. Downside to levels that would have seemed like a generational high just 18 months ago. Let me now make this personal, because I know some of you watching this are trying to figure out what any of this means for your own financial situation. Let me be completely clear up front. I'm not a financial advisor. Nothing here is financial advice. What I'm about to share is scenario analysis based on publicly available institutional data, and what you do with it is entirely your decision. Here's what I think is worth understanding for anyone paying attention to this market. First, the window where institutional positioning is being established and retail participation is still relatively low, that window doesn't stay open forever. Gold ETF inflows added $5.3 billion in February 2026. That is institutional money moving systematically. The history of major commodity bull cycles shows that retail tends to pile in during the final third of a move. We are not there yet. Second, watch the CME FedWatch tool as we approach the March 18th Fed meeting and beyond. Right now, 95.6% of market participants expect no cut in March. If that expectation starts shifting, if the probability of a June cut, currently sitting near 60% for a hold, starts moving decisively toward a cut expectation, that is the signal the gold market has been waiting for. Third, watch the China premium. The Shanghai gold premium compared to London spot is one of the cleanest real-time indicators of physical demand pressure. If it keeps climbing above that 1% level we saw in February, it signals that physical tightness in the market is intensifying. Fourth, and this is the structural point most people miss, watch the Fed chair replacement story. The moment a new, more dovish Fed chair is confirmed, every rate assumption model in every institutional portfolio in the world gets recalculated. The downstream effects on bond yields, the dollar, and real rates will flow through directly into gold. Fifth, consider how gold's role has shifted in mainstream portfolio construction. JPMorgan has published analysis showing that a modest shift in household allocation from roughly 3% gold exposure to 4.6% could by itself justify an $8,000 per ounce scenario. That is not some fringe prediction. That is documented in their client research. The math of even a small structural shift in allocation multiplied across global household wealth is staggering. Sixth, keep an eye on mine supply. Total global mine production sits at roughly 3,672 tons per year. With demand running at 585 tons per quarter from investors and central banks alone, not counting jewelry and industrial demand, the market is structurally undersupplied at prices that don't incentivize enough new mine development. This is a slow-moving constraint, but it is real and documented in State Street's March 2026 Gold Monitor. And seventh, because I want to be balanced here, the risk that makes this picture complicated is inflation. Core producer prices rose 0.8% in January alone, the strongest monthly increase since mid-2025. If tariffs drive another wave of inflation, the Fed not only holds rates, but potentially reverses course and hikes. That would be the scenario that genuinely pressures gold and creates a 10 to 20% correction. It is not the base case of any major institution right now, but it is a real tail risk worth understanding. Let me bring this full circle now, because I want you to see this from 30,000 feet and understand what we are actually watching happen in real time. JPMorgan, $3.9 trillion in assets, the most systemically important bank in the United States, has published a $6,300 gold target. Simultaneously, they raised their long-term gold floor by 15%. Their research team, using a quantitative demand model they've built and refined over multiple cycles, is projecting 585 tons of combined quarterly demand averaging through 2026. Central banks are in the 17th consecutive year of net purchases since the global financial crisis. 2 Fed governors are already voting to cut rates, while the majority holds firm. The incoming Fed chair, whose appointment is expected any day, is broadly expected to be more dovish and more inclined toward lower rates. COMEX institutional net longs exceeded 300 tons as of February 24th. Gold ETFs took in $5.3 billion in a single month. Shanghai physical premiums have turned positive. The all-time high sits at $5,595, set January 29th, less than 6 weeks ago. And JPMorgan is telling their best clients it goes to $6,300 by December. This is not one indicator flashing. This is a convergence of multiple independent data streams pointing in the same direction. And the historical pattern, whether it's the 1970s dollar crisis, the 2008 financial crisis, or the post-COVID monetary expansion, consistently shows that when institutional capital has fully made up its mind on a directional trade in an asset like gold, the market tends to follow. The people who didn't see it coming in 1979 had the same data in 1977. The people who missed the 2008 to 2011 gold run had all the information they needed in 2008. The signs were visible. The question was, who was paying attention and who was positioned? I'm not telling you what to do with any of this. That is not my job, and it is not my place. What I am telling you is that the largest bank in America has put their institutional credibility behind a $6,300 gold target, and the structural machinery to get there, central bank buying, dollar pressure, imminent Fed leadership change, physical demand from China, COMEX positioning, is all visible in documented public data right now. Drop a comment and tell me this. Do you think gold hits $6,300 by year end, or does the Fed manage to hold it back? I want to know where you stand. I read every single comment, and your perspective genuinely shapes what I cover next. If you think there's a scenario the mainstream is completely ignoring, put it in the comments. Some of the most interesting analysis I've done has started from a viewer's observation.